If you try to research a stock, like you should before every buy, you'll quickly find yourself swimming in a sea of data. You might be asking, isn't there a way to condense all this data down to one single indicator that will serve as the telltale sign of the stock's long-term performance? I'd argue that such a metric, even if not a perfect one, does exist. I'm talking about earnings per share growth. Earnings per share is a primary way to measure a company's earning power. Put simply, it shows how big a slice of earnings each share is entitled to. For example, if a company's EPS is $5, that's the portion of earnings you'd be entitled to if you own one share of the company's stock. Let's break it down step by step. A company's earnings emerge out of its total revenue minus the cost of goods sold, as well as operating expenses, debt-related interest payments, and taxes incurred. The per-share part accounts for the total number of shares and will adjust depending on whether the company issues new shares or instead buys back its own stock. Because earnings per share incorporates so many key fundamental things, its growth often follows a similar path as the company's stock price in the long term. The words "in the long term" are key here. In the short term, the behavior of any stock is almost random. It may rise or fall much faster than the company's earnings. In the long term, however, the return of each stock essentially consists of its average long-term EPS growth rate plus any built-in expectations for the future, whether positive or negative. This is why I would advise you to check EPS growth first and add the most weight to this metric when you research a stock.